Today we're diving into the stock of a marine transport company, examining its background, profitability, current valuation, and expected returns. In a brief but thorough analysis, we'll navigate through key factors shaping its position in the global shipping industry. Join me in uncovering the investment potential of this seafaring stock. Hey friends, welcome back to the channel. If you are new here, I am Cody Koch, a 25-year veteran investor, former hedge fund trader, and business owner. And on my channel, I try to make my viewers money by bringing them investment ideas like this one. So let's get to it. Today I'm going to present to you a stock called Euroseas, ticker symbol ESEA. It provides ocean-going transportation services worldwide. The company owns and operates container ships that transport dry and refrigerated containerized cargoes, including manufactured products and perishables. As of May of 2023, it had a fleet of 18 vessels, including 11 feeder and 7 intermediate container ships with a cargo capacity of approximately 56,000 20-foot equivalent units. Euroseas was incorporated in 2005 in the country of Greece. By the end of 2024, they plan on adding another 9 vessels, which increases their capacity by about 50% from what it is today. Now, if you're new to investing in shipping stocks, then something you're going to want to learn very early on is that shipping rates have a tendency to be quite volatile. They will swing around, they will crash very low, or to the point that many ships are not even profitable. They end up scrapping entire fleets of ships. Other times, shipping rates will be dramatically high, and everybody will be making tons of money, and cash flow will just be coming through like a fire hose. It does this due to the cyclical nature of the shipping industry. It's affected by a wide variety of economic factors from around the world. It can have some pretty dramatic swings because of this, which gives us both opportunities and risks at the same time. One aspect I really like about Euroseas is the very high margins that are currently in the marketplace at the moment. Euroseas has successfully locked up most of their vessels under contracts at those high rates for most of 2024. This assures a significant profit margin for at least the next year and a half. So the way I found Euroseas was doing a search online for companies that had low valuations, high profitability, excellent growth prospects, positive revisions on their financial statements, and positive momentum on their stock. Stocks on average that match the criteria I used to produce an average annual return of 24% per year going back to 2010. So first you can see the revenue has climbed quite consistently, and it's expected for the rest of 2023 and all of 2024 to be roughly flat, if not increasing slightly. Okay, so here's the earnings per share estimates for the future. You can see 2018 skipped to 2022. This is probably erroneous data. I will show you the financial statements in a moment. But as you can see here, estimates for 2023 and 2024 show a significant profit relative to the current stock price. Yes, you see a decline here from $15 to $10 per share, but as I'm about to show you, at a $28 per share current price, this is a fantastic return on your investment, as you will see in a moment. Income statement going back to 2013, you can see company started off quite small and has grown significantly over the years. You can see a significant increase in the last few years over their revenues. Go down to the net income level. You can see the last 3 or 4 years they've shown significant improvement in their profitability. There's more detail on the earnings per share, as you can see here. So the company has staged quite a bit of a turnaround over the years and is doing significantly better than it once did. One thing I like about the company is its dividend yield is a little over 7%. Annual payout is around $2 per share. Okay, so on the balance sheet, you can see they have a pretty significant amount of cash, about $48 million. Their long-term debt is around $108 million. That is primarily used as loans to buy their ships. So total assets are about $408 million. Total liabilities are about $163 million. Leaves equity of about $245 million in the business. And just to put it in perspective, the company is currently selling for $190 million on the stock exchange. All right, so next let's get into the most important part, valuation of the business. You get the PE ratio, or price to earnings ratio, for EC is 2 or less. Now to put that in perspective, that means from the profits in the business, the earnings the business is producing each year at its current stock price, if you bought the stock, within 2 years, you will get all of your money back just from the earnings in the business. This is one of the best PE ratios I have seen in a long time from a company that is long-term viable. Next, I want to show you enterprise value relative to EBIT, or earnings before interest and taxes, and you can see these are around 2.7, 2.5 times. This is incredibly cheap as well. That's known as the acquirer's multiple, so that is literally what it would cost us in terms of multiples to go out and buy the entire company. So if we all got together, went out and bought Euroseas entirely, paid off all of its debt with our own money, and then paid back ourselves cash from its bank account, it would cost us about 2.5 times what its current earnings before interest and taxes would be, which means we would get all of our money back within the next 2.5 years, and the company would be free and clear with no debt. Next, you can see its price to book is about 0.75 to 0.8. This is pretty good. This is undervalued for vessels. One thing to kind of keep in mind when you're analyzing shipping companies, to some extent, you can consider them real estate floating on the ocean. They're very much a hard asset, just like real estate. They rent out space on these vessels and so forth. They are a bit more complicated than real estate in general, and they definitely are more volatile in terms of their profitability. But when you look at it from that point of view, a price to book below 1 is pretty decent. If you are enjoying this video, please hit that like button and subscribe. Real quick, I want to do a comparison of these valuations, and you can see Euroseas, as I said earlier, selling around 2 times earnings. Over the last 5 years, on average, Euroseas has sold at about 5.77 times earnings, which puts it at almost 3 times what its current price is. As you can see, its acquirer's multiple, like I said, is about 2.5. Over the last 5 years, on average, Euroseas acquirer's multiple was somewhere between 15 and 20 times earnings, which makes it about 8 times more than its current price. And its price to book was 2 times over the last 5 years on average, compared to its current 0.8, which means it's a little bit over a double from its current price. In terms of its profitability, you can see Euroseas actually has a very good return on total capital relative to its industry. There's 88 stocks in this industry. As you scroll down, you can see it's definitely in the top 20% in terms of profitability. Also, in terms of its margins, Euroseas is doing very well compared to a lot of its competitors. Overall, the company's very profitable and doing a very good job relative to its industry. Okay, so for Euroseas, going back to 2018, actually, you can see that the stock is up about 200% over that period. And you can see here that it was at one time quite a bit lower. It was around $2 per share. And they had a significant improvement over the last handful of years, got up to about $36 a share, a little bit of a dip, and then it's back up to around $28 a share. But its profitability has dramatically grown. Its fleet has grown significantly over the recent years, very profitably. And so it's looking quite good for at least the next 3 years or so. Okay, so next we're going to talk about the major risks with this stock. Now, the number one risk and pretty much the primary risk for this company is that shipping is a very volatile industry. Things can boom and bust quite significantly in this industry, and for that reason it keeps a lot of people a little spooked, and that's also why you can sometimes find significantly undervalued opportunities like this one. Now, how companies in the marine transport industry overcome this extreme volatility is they use long-term contracts. And in the case of Euroseas, they've already contracted out the vast majority of their fleet throughout all of 2024 and beyond. So the sales and profit estimates that we're seeing here are much more likely to be accurate based on those contracts. The reason these contracts are used, of course, is to allow for consistency in an otherwise very unstable marketplace. And since Euroseas has contracts out to 2024 and into 2025 for most of its fleet, it's expected that Euroseas will produce around $11 per share in profit through 2024. Naturally, the company will continue trying to get as many contracts at these higher rates for as long as possible into the future. In addition to this, the company is planning on adding 9 new vessels to its fleet throughout 2024. And so since it currently has 18 vessels, they're going to add 9 more. That should increase their capacity by approximately 50%, which hopefully dramatically increases their profitability as well. So next I'm going to do a scenario analysis to be able to derive our expected returns from Euroseas. So as you can see here, I always like to start off with the worst case scenarios. An old saying in investing is look down first, not up, whenever you're trying to evaluate an investment. In other words, you want to look out for your risks. So what we're going to do here, as you can see, I have an estimated 5% chance that the company is going to go completely bankrupt and the shares are going to be worthless. Okay, now this is an extreme case. I do not believe it's actually anywhere near that high. It's just kind of an exercise to keep me focused on the very real possibility that almost anything can happen in the investing world. So I estimate a 5% chance of losing 100% of our investment. Next, as you can see, I have a 15% chance of the stock declining by approximately 50% from its current price. So that would mean it would go from around $28 to around $14 per share. The reason I estimate a 15% chance of this happening is I've been doing this for a long time. I've seen all kinds of crazy stuff and many things can occur. Perhaps the marine transport industry hits upon hard times again, the market crashes for freight rates again, and the stock ends up going down with it. So any number of things are possible here. Next, I estimate a 30% chance of the stock declining about 20% from where it is today. That would put it at around $22 per share. The reason I estimate that, of course, is anything can happen. It could just be a normal up and down of the market. It could easily have a decline of 20%, so I always throw that in there. On a positive side, I estimate there's around a 30% chance at some point we're going to see a 50% increase from its current price around $28, which would put it around $42 per share. If my investment thesis works out at all, there's a pretty good chance we're going to have a 50% increase. Next, I estimate a 15% chance the stock will double from its current price. It'll go from $28 to $56 per share. This, I think, is quite possible due to the fact that it's so undervalued and I see a lot of potential in the company. Lastly, as I told you previously, the acquirer's multiple was at 1.8 times higher than it currently is. In the outside chance the stock gets back to that level of acquirer's multiple, I'm estimating maybe a 5% chance of that occurring. That means the stock would go up about 800% 50% from its current price, which would put it as high as $252 per share. I know that's a dramatic outside chance of that occurring, but it is a very real possibility given the nature of the industry. Unlikely, but it is possible. So we do some algebra on all these statistics and these probabilities. You'll notice there's a 50% chance of the stock losing money from here, 50% chance of the stock gaining. I estimate there's approximately 51% expected return on this stock over the next few years. Theoretically, this should beat the S&P 500 quite significantly. All right, next, let's talk about risk management. Now, this system is not really designed to have stop losses, and you can't really use options contracts like puts or calls or anything like that to lower your risk dramatically. So the best way to lower your risk with this type system is to use proper position sizing, and I recommend you put no more than 5 to 10% of your entire portfolio into this stock. 10% absolute max. Anything above that's just too much risk. Now, of course, you want to exit the stock someday. What I recommend doing for exits in this case is after you buy the stock, you hold it for a little over 1 full year. The reason you want to do that is because it lowers your taxes dramatically. You can get capital gains taxes if you own it for past 1 year, and also a full year gives it time to mature and gives the chance for the investment to work out. Now, once you get past that full year, go ahead and reevaluate the stock. Generally speaking, the longer you own these stocks, the more profitable they will be. Next is the trade execution. Now, this stock, it's a small cap company. Because of that, a lot of the time it'll have wide bid-ask spreads, and so I really recommend when you go to buy this stock, you use one of 2 methodologies. You either buy at the end of the day. It's called buy on close. That's pretty simple. Get you in. You're pretty much guaranteed to get in, but you may get some slippage from that. If you're worried about slippage because of this wide bid-ask spread, what you may do is just go into the market and put a limit to buy order below the prevailing bid on that stock, just a little bit below it, and just wait. Typically, 90+% of the time, you will have that order filled within a few days. If you're not, give it a little bit of time, and then if a week or so goes by, go ahead and reset that bid a little bit below the new prevailing bid. Usually that means it had gone up in price a bit, and just put it in there and wait some more. Generally speaking, you will have been able to buy the stock at the prevailing bid, which will save you a chunk of money in the long run. Next is psychology management. Now, this is probably the most important thing of any type of investing or trading, and I really recommend the way you do this is once you buy the stock, put a calendar alert on your phone or your computer for a little bit past 1 year. And that calendar alert's basically going to tell you, hey, check out ESEA stock, look at it, reevaluate, something like that. In the meantime, do not even look at the stock. And the reason you don't want to is it's just going to put stress on you. You don't really want to worry about it. If it's gone up a lot, you're going to feel stressed because you want to sell it. If it goes down a lot, you're going to feel stressed that you've lost some money. Whatever the case is, you want to own it past that 1 year, and you do not want to look at it until you get that calendar alert. This is a fantastic way to help manage your psychology when you're dealing with stressful events and situations like this. So in this video, I did a deep dive of the stock of Euroseas, but in a previous video, I did a deep dive into a very undervalued medical device company called Similar Scientific. You can watch that video here. And if you would like to continue to see investment ideas like this, please hit that like and subscribe button, and I will see you in the next video.